All right, so real estate case studies. I started investing in real estate in 2017. I bought a single family house with my partner Matt. Matt's my partner, he's our broker, and he also, owns this company with me. And prior to buying that first house with Matt, I was invested in stocks, I was buying Apple, I was trying to day trade. At the time, this was 2016, 2017, marijuana stocks were blowing up because of Canadian potential to legalize marijuana or decriminalize it federally in Canada. And I was buying some other stuff too. And I really didn't have this big interest necessarily or big goal to do everything that we've done today within real estate. But Matt at the time, was very involved in real estate. He was already a broker. They had a property management company. He had been in real estate for the previous, 6, 7 years or however long. And anyways, he had, I think 5, 6, 10 houses that he owned with he and his wife. And he had said, hey, I got this deal. Wholesaler had sent it to him. It was in Austin. The price originally was $109,000, which was a very good price even then. And he said, hey, why don't you buy this house with me? Put in 50% of the money, on 50% of it. And we did that, and that was my introduction into buying real estate. What I really liked about real estate is a few things. Number one is the ability to utilize leverage. And I'm sure you can utilize leverage with stocks and accounts that allow you to have leverage, or gold or silver. I don't know if you can with Bitcoin unless you just got a loan to buy it. But what I really liked about real estate was the ability to put in, 5 to 25% down and have, 75% plus financed. This was really important because we don't have to go out and buy real estate cash. We can use banks to buy real estate. The tenants will pay us rent. The rent will pay down the operating expenses and also pay off our debt payments. And the tenants are effectively paying down your debt payments, every single month, right? So I really liked that about real estate. What I liked about real estate was the ability to buy under value. So, if you were to log into your Fidelity account, your Schwab account today, you want to buy, 10 shares of Apple, you can go in there and you can, place a bid for 50% of what the price is today, but it's not going to sell, right? It's not likely that you're going to get that order fulfilled. With real estate, if it's worth $200,000, you can go in, offer $100,000, and it's up to the seller if they want to accept it or not, right? And that's what we did with that first property. There ended up being a HUD lien on it, so we didn't buy it for $109,000. We ended up buying it for $134,000 or so. But it was worth at the time close to $200,000. So immediately day one, we were walking into $70,000, give or take, worth of equity. So we bought into it and we had the ability to make our money the moment that we buy it because we bought it right. The next thing that I like about real estate is depreciation. Everybody familiar with what depreciation is within owning real estate? Someone tell me what it is.
So basically, I think it's like 27.5 is the term of depreciation. You can depreciate an asset for every year, and basically you can subtract that depreciation from your income, gain, cash flow.
Yep, so
tax levy, basically.
For residential properties, 27 and a half years, straight line depreciation, which means that whatever the improvement value of the property is, you can depreciate that the same amount every single year for over 27 and a half years to offset the income. Now, there are other ways that you can accelerate depreciation and take 27 and a half years of depreciation within 3 to 5 years. Now, there is a recapture on the back end if you were to sell, but there is ways to take more depreciation up front and accelerate it so that you can take a bigger loss and offset more income. But just in general, depreciation is a benefit. Another important one, cash flow, right? If you're holding on to rental properties, apartment buildings, warehouses, retail, RV parks, whatever it might be, one of the things you're buying for is cash flow. This is your income. You get your rents minus your operating expenses, which are management, taxes, insurance, maintenance and repairs, leasing commissions, utilities if you're paying for those, vendors, etc., right? All the operating expenses used to operate that property come out from your rents. Then you're left with your NOI, which is your net operating income, the difference between your income and your operating expenses, minus your debt payments. And if you buy it right, you should have cash flow after all of that. And so this is your income every single month. For the retail shopping center that we're buying in Florida and that Timberly is investing in, this one is cash flow on day one. We've already negotiated lease renewals for all the commercial tenants. It's a 10,000 square foot building on a highway. It has tenants such as like a pizza shop, Chick-fil-A is there, their corporate center. There's like massage parlor, there's a CBD shop, and a few other places that are like that, local businesses that serve Pace, Florida. Now the owner had it pretty far below market rents, and he also was not charging back some of the operating expenses to the commercial tenants like you normally do on triple net leases. So he was still paying the taxes, he was still paying the insurance, and he was still paying for a portion of the utilities. So what we did is we got it under contract because he had all these on annual leases, which also is not great, and the banks don't like that. They want to see 3 years plus, 5-year long leases with the commercial tenants. And so we went in, we spoke to all the tenants during our due diligence process, and we negotiated rental increases of about 30 to 40%. So we're already adding a tremendous amount of value to the property before we even close, right? Now that property though will produce good cash flow. The rents on that property are gonna be somewhere around 180K after the rental increases go into effect. Our expenses are gonna be very minimal because we are not paying for taxes, insurance, and things of that nature. The tenants are, but we are paying about $1,500 a month in a management fee. So our expenses are going to be about $18,000. So my NOI is going to be $162,000. Our debt payments are going to be close to about, I think, $105,000. So what is our cash flow?
58,000 a year?
Yep, cash flow is $57,000 a year. Now, we're going to put about $530,000 down to buy it. This is going to include us paying for a new roof. This is going to include us doing landscaping of the property. This is going to include us improving the signage, having a little bit of reserves, and the down payment for the loan. So what I want y'all to do is divide $57,000 by $530,000, which is the amount of cash we're putting into the property, and tell me what the percentage is. 10.75% cash on cash return. Because at the end of the year, we're going to get $57,000. We put down $530. 57 is 10.75% of 530, which is a 10% return. Cash flow. Now, we are buying this property for $1.45 million. And this is based on his previous NOI of about $135,000. Because remember, we're raising the rents. So we're buying it at about a 9.3 capitalization rate, meaning that the NOI that he currently has is about 9.3% of the purchase price. And he's selling it to us at a discount. He really should be selling it to us somewhere around 1.8 million. Again, going back to buying the property under value. So day one, if we left it as is, we're already walking into about 400,000 give or take worth of equity without doing anything. But because we raised these rents and we raised the NOI, we're creating additional value. And it should be selling at somewhere around, right now, probably like a 7.5 capitalization rate. He's selling it at a 9.3 capitalization rate, which means we're getting a good deal. And so what I want y'all to do is take this 162,000 and divide it by the capitalization rate of 0.075 and tell me what you get. 2.16 million. So the moment that we raise the rents and raise the NOI and pass back the expenses to the tenants, our property is going to be worth 2.16 million. Now, that's very valuable, right? Within 6 months, we've created $750,000 worth of value by simply just going to the tenants and saying, hey, your rent is now X, right? It didn't really require that much work other than getting the document signed. Now, we are going to improve the property, but that won't require that much work either necessarily. And so with real estate, we've created $750,000 worth of value. We're getting over a 10% plus return, cash flow, all based on leverage, buying undervalued. The cash flow that we do get here is going to be offset by our depreciation, which means we're not going to pay taxes on it. The cash flow is really important. And what we can do is we can refinance it a year later if we want to, and pull all of our money back out and be into this investment for $0, continue to gain cash flow for however long we decide to hold on to it. But the leverage piece is really important, because if we bought this property for $1.45 million cash and we improved it, by $750,000, it's really only a 50% return of value based on the cash that we put into it, right? But because we only put $530 in, it's about 150% gain on value based on the cash that we put into it. Does that make sense? What questions do you guys have about this deal or what I'm talking about?
How do you find the deal?
The deal was actually found. He filled out a form on our website. Sell my commercial property fast for cash.
How do you come up with the market value? Like obviously you have the deal value, but how do you get the number? Like if we were to turn around and sell it, it's crazy.
So just like, this house has a value, this house is valued based on what the house next door sold for, right? It's based on comparables in the market. Now, commercial real estate sells a little bit differently than residential real estate, and it's valued differently. It's valued based on the income that it brings in. You're buying a business, that business produces net operating income, and commercial real estate is valued based on the net operating income that a business brings in. Now, different markets have different ways of valuing that income. Different classes, different locations, when it was built. Like the Amley properties that are in downtown Austin probably trade at like a 3.5%, 4% cap rate. Now, a 3% cap rate is pretty low, but because it's brand new, it's in downtown Austin, the risk of this property not producing and not staying leased and not appreciating in the future is so low that it sells for such a high price. Now, this property in Pace, Florida has a population of about 25,000 people. It's a little bit north of Pensacola, Florida. This property is not an Amley property that would sell at a 3 cap. It was built in like the 80s. It is on a good location on a very busy highway, but because of its class, because of the market, because of the location, you're going to be able to buy it at a much lower price than if that property were sitting in downtown Austin. And so Pace's market trades at about a 7.5 cap rate. Now, a lot of that is dependent upon interest rates. When interest rates go up, cap rates go up because it costs you more to hold on to the property. When interest rates go down, cap rates go down. And so it trades off of the cap rate, and that's how it comes to the value. The thing here with this one is that the interest rate is a little bit higher than we were expecting. We're getting an interest rate of about 8.5, and it's principal and interest payments, which is making this a little bit higher. But typically, if you do have good debt, the cash on cash return is much greater when you're not paying cash for properties and you're utilizing leverage. Now, what we plan on doing with this one is either selling it in about a year, or when interest rates lower, what we'll do, let's just run with the $2.2 million value. Let's say in about 18 months, we go to the bank, a new bank. I don't like the bank that we're with right now, but let's say we go to a new bank and we say, hey, we get an appraisal, it appraises at 2.2. Our loan balance is going to be somewhere around 1.1 million with harvesters. And we say, hey, we want to get a loan on our property here at the new value, 2.2 million. And they say, great, we'll give you 75% of 2.2 as a loan, which is 1.6 million. And we're going to give it to you at a 6% interest rate. And we'll do interest only for the first 5 years of the loan. And then the rate is going to adjust. So if we take 1.6 million and we multiply it by 0.06, It means that our new debt payments are going to be $96,000 a year, and they're going to give us $1.6 million. It'll pay off the original loan of 1.1. It'll pay back our money here. We'll be out of the deal with $0. We'll have a few closing costs and stuff with the new loan, and our new debt payments are going to be $96,000. So our cash flow is going to increase to $65,000, $70,000. All the investors are going to have all their money back. They're going to be receiving cash flow of total of $65,000 a year with no money invested. What is the return of $65,000 a year on $0 invested? It's infinite, right? It's an infinite return. And that's the beauty of real estate, is doing the cash out refinance, taking the cash that you had in the property and the equity, redeploying it into another deal, and continuing to build up your assets based on the first initial investment. And that's what I did with Matt over and over and over and over and over again from 2017 till now. We're still doing it. And we own a bunch of different properties. We own probably a total of about 130 or so doors, and that's comprised of single family houses, 2 to 4 units, duplexes, triplexes, quadplexes, small commercial apartments, 8 units, 9 units. We have a mobile home park in South Austin, which is a really great property. We're buying this retail strip center that I just went over with you guys. We have a 125 slot RV park under contract in Terrell, Texas, which is 20 minutes from Dallas.